The labor market is tight, inflation is up, and the Fed is in big trouble. That's what we're going to talk about today, here and now. I'm going to explain to you why in the news they're making everything look like it's rainbows and unicorns, and I'm here to bring you the truth. How it affects you, your retirement, your portfolio, all of that will be discussed in today's video. And at the end, I'm going to explain to you why this is really something that we should pay attention to related to how the markets are moving. I'm going to show you the key you need to know. Let's begin right here with this. Private sector companies added 497,000 jobs in June. This is like double the expectations. It was a blowout. They said, wow, the economy is so strong. There's just one problem with that. However, if the economy is really strong, the labor market is tight, this is a signal for the Federal Reserve. Let's quickly break that down. The Federal Reserve has to look at a few things. One of those is inflation. We know that. And so while we do have the CPI inflation and the PPI inflation, that's the consumer prices and the producer prices. Some people don't know what the producer price is. That's like, think of like the raw materials and things. That is then going to come down over this last little while. Okay, fine. But the core prices, when they exclude, the Federal Reserve excludes what they call volatile food and energy prices. In fact, it's been basically at the same level for the last year. And so that means these are getting sticky. The level of inflation is staying around in this one aspect. So that's inflation. The second thing is related to the jobs market. And when you look at the data, there's a lot to cover. You can take the U3 unemployment rate, the rate that you normally would get. It's near historic lows at this time. In this way to look at it, the jobs that are created every month. Okay, now maybe you fire 500,000 people and then the next month you hire them back. Or you could potentially be a temporary worker and every single month you're getting hired. That's another way they can manipulate the stats. You can have 2, 3, 4 jobs and then that looks also fantastic. There's lots of ways that isn't exactly accurate. There are other things though. You have the civilian labor force participation rate telling you how many employees are actually out there. And of course, that's still looking weak. So there are many different ways to look at the jobs. And I just want to explain to you that that's what the Federal Reserve is looking at. They're looking at how tight the labor market is. And at this time, you have millions and millions of open jobs. You have a lot of these businesses that cannot get workers, the lower paying jobs. They are, still today, although it's not what it was, let's say a year or two ago, that they are trying to get people in the door. And so they may be dealing with a problem, but they do not want to lay people off because they might not be able to get them back. So they're simply keeping them on payroll, knowing that that's a half of an employee, and they just don't want to get rid of them. So the Federal Reserve is watching this. Now, how can they, and this is what I want to get to, how can they actually increase the interest rates, or I should say cut interest rates, or even keep them where they are, when the markets are doing this, labor markets are doing this? That's the challenge. And the Federal Reserve knows this, and the investors know this. And that's why in response to this very good statistic, the markets came down quite a bit. And that's really what we're talking about here and now. The Federal Reserve is everything. The markets, like I've been telling you, had believed that cuts were coming right around this time frame. And it doesn't look like they're getting that. In fact, it's going to go the other direction. You see? You could look at this. The 2-year Treasury yield hits 16-year high after ADP jobs data shatters expectations. Just imagine this. I wanted to show you this chart. Look at how short-term these are. 1 month, 3 months, 6 months. You are getting over 5% yield on a very short-term debt. Now imagine you could take that and continuously, as it matures, you just keep rolling it over, rolling it over, rolling it over. Investors, take note. Imagine this, that you could be just rolling this 5% over and over again. And even if it falls down to 4%, then maybe it goes up to 6%. Do you see what's happening here? that you are getting a potential opportunity on this very short-term yield to start making this, utilizing it instead of speculating like I'm going to buy this asset and maybe next year or 2 years or 5 years it's going to be really good for me, where a portion of your income or of your expenses or investments, I should say, could be used in this way. So I just wanted to make that clear, okay? You got to take this information and utilize it. Mortgage rates soared to 7.22% after strong economic data. This has been the case. Of course, we have seen it elevated. It dropped down under 6%. So after going above 7%, it dropped down under 6%. And now we are back to 7.22%. It's all about expectations, where the market believes interest rates will be in this near term. And right now, after fighting it all off, the markets believe that it's gonna, actually be increased. One of the points where we had, the bank crisis and so on, this is when we started to have that change. Oh no, banks are failing. Obviously, the Federal Reserve is going to cut interest rates any moment now, but they didn't. So this is what we have. Mortgage rates are rising. The higher mortgage rates go, and number two, the longer they stay elevated at these levels, the bigger the problems are. Commercial real estate, that is your number one biggest problem. You got to understand, by the way, I know that for residential real estate it doesn't work like this, but in the commercial side, we're talking about short-term debt, which needs to be refinanced very soon, by the way. You also have that circumstance where those markets are very tight. It's actually hard to get debt. If you want to take out, let's say, a $50 million loan, $100 million loan, it's going to be extremely difficult right now. That's what we got to understand. All right. Bank of Canada to raise rates 25 basis points on July 12th. And so depending on when you are seeing this video, you are going to see this before that. I think it's important to note that the Bank of Canada had stopped. Oh no, we're done. We're done with interest rate increases. That's it. And then of course it made real estate investors happy, the mortgage brokers happy. Everybody was so happy. However, they increased. Australia increased, and now doing it again. So they would go 50 basis points, 0.5% higher than where we were just a couple months ago. So this has gone way further than where really anybody expected them to be. Now, I believe that you look at the history, you look at those charts, and you will see it for yourself. They never stay. Whenever they're going through a hiking cycle, it gets to a certain point, something breaks. It stays there for a few months, and then they immediately start cutting interest rates. But something has to break. Remember that. They don't just cut interest rates. All right, job's done. Let's bring those interest rates down. Let's do it slowly and cautiously. It doesn't happen. Something breaks. What's it going to be? Is it part of the bank crisis? Is it something else? We're going to find out, okay? I want to make that clear. And on this channel, I'll bring you all the data you need to know. Just hit that subscribe so that I can give you a clear and concise picture of what your world is going to look like. And we see that unveiling right now before our very eyes. Fed lending to banks eases a bit in latest week. Now, I wanted to show you that. You can look at these things for yourself. And really, really quickly, I want to switch over my screen if I can do this without messing it up. Take a look. So you're going to see this messed up chart. I realize that. But I wanted to make something very clear when we're looking at this. This is what I call the money mirror method. I'm going to link to it at the end of this video. So stay tuned. Really quickly, I want to just cover the fact that, by the way, it's a messy chart. I realize that. It was covered, though, in that video, so you can take a look. I am building an entire course around this as people requested it. I didn't know what the demand was. Now we can see that there is demand, so I'm going to build a course around it. But essentially what we're looking at is the stock market. That's the white line. And you can see that in comparison to these different levels of liquidity. There's all these different measurements of liquidity, one being the Federal Reserve's quantitative easing, or essentially the balance sheet, and what they've been doing right now, quantitative tightening. And isn't it so curious that the markets have been weak right around the same time that the money mirror method triggered bearish signals? Okay. Now, that doesn't necessarily work on a day-to-day basis and so on. That's not the way that this indicator works, but overall, it's still maintaining its integrity. And I find that interesting. Now, let me switch back. If we go here, and I will cover this really quickly. I want to show you something. I want to make this clear for everybody, okay? So this is basically looking at the Richcession, okay? Richcession is basically suggesting that people making the higher incomes, people that are, generally more well off, the white collar workers, they are the ones that are actually struggling more so than we see, with the blue collar or people that are entry level. Okay, maybe they're working at McDonald's and so on, because the demand for those positions is actually higher because nobody wants to work for, let's say, maybe it's in some areas $8 an hour, or $10 an hour, $12 an hour, as everything is becoming too expensive. Okay, so I completely understand. So that's basically what is happening here, and there's more layoffs taking place with a lot of these jobs, white collar jobs, being hit hard. And what they're saying is that this is kind of balancing out the spectrum, where the rich are not necessarily getting richer. I think we're talking about, like, let's say in the bottom 80%. Well, what's happening here? Or maybe, sort of the middle range there, that might be balancing out. But let's be clear. Let's be honest. Those in the top 1% of 1%, they still own everything. In fact, even more than ever before. And we got to be aware of that. So what do you think Americans say that they need to earn to feel rich, or even just financially secure? What is your guess? Just take a quick guess right now. What's that number per year in US dollars? What would it be? Obviously, it's going to depend where you live and so on. Your circumstances, how many dependents you have. Do you have major healthcare bills? What do you think that number is? For a lot of people, they would say 100,000. All right. Some people might say, hey, I'm a single person. I live by myself. I got very low expenses. House is paid off. I'm going to say 50,000. Others might say, I live in San Francisco. I live in the, all these, the tech companies all nearby. I got to show off, keep up with the Kardashians. Well, if you can believe it, the number was 233,000. 233,000. I mean, it really depends. By the way, 483,000 to feel rich or attain financial freedom. That number is rapidly changing, because for a lot of people, they don't realize that these circumstances with inflation are really becoming difficult for a lot of people, no matter what level we are at. And that's really, clearly being dependent on what the Federal Reserve is doing, what the central banks are doing. And that's why we got to watch the liquidity. If we watch the liquidity closely, we're going to be able to paint a picture of what's happening here. That's why you don't watch the news. That's why when you watch the news, you watch it to laugh. It's a comedy routine. I generally, if there is a news video in an article, I will never watch that video. I will read through the article. I much prefer that because it's just nonsense. The news is there to cloud your judgment and say, come to us. We are the authority figure. And instead, we should just have unbiased information and try to bring that to you in a way that's simple and easy to understand, but still doesn't, shy away from the truth. This is the money mirror method. And inside that, we measure liquidity. We look at this, and I break down the general formula for you for free right here in this video. Click on it. I'll see you there.